Dharmesh joins us now. Let's take a conversation forward and understand from him that what he makes of the earnings season and the current market at the current juncture. Ravi, good to have you back. A month ago, the markets were disturbed, and we were, in a sense, focusing on the breakdown part of the market. Uh, Now we are talking about breakout. 4 weeks, and the temperament of the market has changed. So, what is real and what is sustainable?
No, I think for sure it's the breakout part that is going to sustain. Eventually, at some point of time, India will break out. And if you see the kind of, India has been an oasis in the world, and for a good reason. Our currency has been stable, our bond yields have been stable, interest rates hikes have not happened. Crude has come down to favor us despite all the geopolitical news that is coming out, the war between Russia and Ukraine, and the kind of the turmoil that is happening in the US banking sector. The macros for India are actually getting favorable, and I think a lot of that credit goes to the fiscal management as well as the monetary policy management. I think RBI took a brave step where they actually kind of preempted what Fed was going to do. And that is why India is standing out in the world. Now, Indian markets are also standing out. Indian economy is also standing out. Our GST collections are at a high. PM services PMI is at a high. Result season has been quite decent. So all in all, I think India is actually justifying its place in the world. We are the only one that which are like 2-3% away from making a new high.
Ravi, the problem with the odd one out is that you also become crowded and bargains are not there. So the fact that India is the oasis and India is the go-to economy right now, some would say it is yesterday's trend. But markets always look at forward numbers.
So we are not used to this kind of attention. We are not used to being the best performing market in the world for a long period of time. But you have to think of it this way: if you are going to go from $3.5 trillion market to $6-7 trillion market, which will probably be number two or number three in the world, number three most likely, then this will sustain for a long period of time. We will have to get used to it. A consensus in opinion that is not the same as consensus in positioning. Not everybody is positioned. So last year itself, we had about $40 billion of outflow out of India, despite the fact that India was standing out. So India FII's holding in India is probably at about 16-17%, which is the lowest it has been since in almost 2 decades. So we might be in a consensus in the form of an opinion, but not in terms of positioning, I would say. In fact, till last week, till probably day before yesterday, FIIs were net short on Indian market. So that tells you that we are not in any kind of euphoric or consensus trade where India has done way better than others, and now we are at the precipice of a fall or anything like that. In fact, I think it's only now that that incremental dollar will also start coming back. Last 2 weeks have shown that India cannot have too much of FII outflows for a long period of time. There are very few options available even for those FII, so they will have to come to India. And now we have the ability to absorb 20, 30, $40 billion kind of an inflow in a year.
Ravi, it's a great point that consensus in opinion and consensus in positioning are two separate things. But there is one sector where consensus in opinion and positioning, I think, is also there, and that's financials for you.
I disagree with that statement that there is, again, the positioning is not there. In fact, I think out of the $40 billion outflow that happened, $20 billion went out of financials. Now you just juxtapose it with the fact that US regional banking is facing a severe crisis. The larger banks are being called upon to support the smaller banks. And of course, yesterday Fed made a statement that that was an exception. It's not likely to happen. But what that tells you is that elsewhere there are problems created by the lending sector, while in India it is the strongest sector. In fact, nobody talks about an asset quality deterioration or any of those things. What all we keep discussing is, will there be an impact on the NIMs? Is the growth going to be high enough or no? And in fact, I find financials as the only place in the market where there is a combination of growth as well as value. Most of the places have growth, then the valuations are not in your favor. Or if the valuations are in your favor, then there is no growth on the horizon. So financials is the only place which has growth plus value. and will be the first port of call for any foreign money that will be coming into India. And I think what will happen is maybe the second tier and the third tier rung in the financials will also start benefiting from this. So now we are witnessing probably some change of guard. We have already witnessed a change of guard in the large banks. Probably we are going to witness a change of guard in the large NBFCs as well. So some of the performing ones will probably get outpriced before they even come down.
Okay. 40 seconds for market open, Ravi. I'll request you to just hang in there. We'll just open the market, establish the first rates, and we're just coming right back to you. 40 seconds for market to open. It's not going to be a rip roaring start, but the fact that you've added 1200, 1300 points from the recent low and you're holding on, and crude is down and flows are back, it just tells you the appetite to buy along, the desire to stay long, I think is there. And trust me, another 2-3% more, another 500 points on the Nifty more, then the FOMO is going to start. I don't think that FOMO is there. Everybody is thinking right now that, oh, should we wait for the decline? Let's wait for the decline. But if the decline ain't coming, then the FOMO crowd is going to come back. Today, everybody is saying that, okay, niche le lenge. I don't think the FOMO is kicking. First rates, we'll make it very quick. Ravi is standing by, so we'll just establish the first rates here. Not too many newsmakers actually. Tata Steel market reacted to numbers yesterday. Titan markets are reacting to numbers today. Crude derivatives, oil, tire, airlines. That is going to be the real guru space now. The decline in crude is nothing but vertical. CEAT is flat, Apollo is flat, and MRF illiquid, but 93,000 rupees for MRF. JK Tire is the one which is bouncing right up. Paints, first beneficiary. Now it's tricky to say that crude goes down, paint would benefit. There would be inventory gain, inventory losses. Some of them cost would be retained. So it's not like a algebraical equation or a linear correlation which you can draw in terms of earnings, but yeah, markets are markets. In the short term they will react. Airlines, one down and four more become more strong. Crude down, Indigo goes up 2168. Actually there is SpiceJet. I want to look at SpiceJet. I mean, we know what's happening in Goa, but I want to mark SpiceJet 2132 and a half for SpiceJet. So now that we've established the first rates, no large fireworks, I'm just going to connect it back with Ravi once again. So Ravi, I'll take that point on financials again forward. You're making a point that a combination of decent valuations and high growth is there in financials. So what to your mind would be that point where you would say that financials are becoming expensive?
So I'll tell you what stage of the cycle we are in. Okay, post the IL&FS crisis, actually we had a kind of separation of men and boys on the lending side as well as on the borrowing side. People could not, on the real estate front, for example, many people fell by the wayside who could not sustain their balance sheet. On the lending side, whoever was very aggressive in the previous cycle in lending was clearly facing issues. But if you see as a sector, the overall leveraging of the economy has just started. It's probably 2-3 quarters old. So usually in lending, the problems with lending come 3-4 years down the line. So I see a clear runway available for the next 2-3 years before any kind of asset quality issues crop up at a sector level. There could be an odd one because of an airline going bust or something like that. But again, those are not systemic issues, and they might in fact be absorbed very well in a high growth environment. So if the asset quality cycle is in our favor, the growth, the leveraging cycle of the economy has just picked up, and the valuations are still reasonable. I don't see a reason to be worried at this juncture. Let's give it some time. Let that releveraging happen, and then we will see who was the one that kind of lent recklessly.
Right, absolutely. A couple of other stocks, though, which are reacting to their numbers. So you've got a Bajaj Consumer, you've got Sona BLW, you've got Sula Vineyards as well, and largely good numbers from here. And I just want to check in on what Aavas Financiers is up to. More than the earnings, the impact would be of the MD resignation, Sushil Kumar. That is going to be one thing in focus. Also want to check in quickly on the Nifty IT as well before we take it back to Ravi Dharamshi and chat about that with him as well. The Nifty IT, though, largely flattish. But Ravi, looking at the Fed commentary overnight, would you say that the worst for IT could be behind us? I mean, now they're pretty much predicting that it's going to be a mild recession at best and, calling it out as that. You think the worst of the damage could be in the price for IT stocks back home?
So there are two issues with the IT. One is obviously the margin contraction because of operating deleverage playing out, and the second is the growth. I feel the growth slowdown yet is not completely factored into the IT companies. Also, we are not very clear. Fed might say that they might have a mild recession, but interest rates going from 0 to 5.25% in one shot in the shortest period possible. We don't know where this pain will show up. Right now, it is showing up in the regional banking sector, but tomorrow it could be something else that could start hurting. So I would wait and watch before concluding that this is only going to be a mild recession. And also, valuations probably will get a little more attractive from here as well. If nothing, that at least time correction has to be there before we can say, okay, the worst is over for the IT sector.
Ravi, so if somebody is buying IT, what should be the general thought? I mean, you're buying companies which are growing at 8 to 10% and available at P multiples of 15 to 20 times. I mean, is that the construct now?
No, so clearly IT is a mature industry, and one has to accept that we are never going back to maybe 17, 18, 20% kind of growth. Yes, there will be some companies within the sector, the mid-sized companies or the small-sized companies that can grow faster. But as a sector, I don't think we can expect beyond 8 to 12% kind of range. In very good times, it might be 12%. Otherwise, it will be more closer to 7, 8%. So that remains the overall broad construct. And for that kind of a growth profile, I will not be willing to give more than 12, 15 multiple, at least at entry point. Market can end up extrapolating, but that's okay. I mean, I'll probably exit at a 20 plus kind of a multiple in IT sector.
Investing right now for next 3 to 4 years, what is the template you're following? I mean, this is the P multiple beyond which I will not invest. This is the growth which I think becomes an essential assumption for me when I'm investing in my portfolio companies. What's the template for 3 to 5 years for you?
So first of all, for us, we like growth. And when I say growth, we are looking for companies and sectors that can actually grow 2x of GDP and not only 1x or less than 1x of GDP. So that is why IT does not attract us so much at this point of time. We are looking for companies that grow 25, 30%. And we are willing to pay a multiple for that kind of a growth from a 3 to 5 years point of view, provided that the factors that are leading to growth in profitability are likely to remain intact for that horizon. So we essentially look at companies which are riding a kind of a broad, larger uptrend and can sustain the growth as well as profitability.
Ravi, in your thoughts, the last time we spoke, you were talking about as to how energy transition is a mega trend. Have you added more new names beyond Praj to this theme?
So unfortunately, there are not too many players available in the listed space. But as you are aware, we have already started. We have launched our private equity fund as well, and we are placing one bet on the private equity side, but nothing on the listed side.
Let's discuss what is there in the public domain, and I'm purely speaking about what is there in the public domain. If I go to your website, there are some portfolio companies which you'd showcased at your Inflection Summit about a month ago. AU Small Bank, Wari, you had representation from some of these companies. So I just want to understand that why have you decided to go for mid-tier banks? Why not large-tier banks?
No, so it is not an either or for us. We do own large tier banks as well. But over here, I feel AU is one of the best combination of growth plus ROE profile, and there is a trigger in terms of at someday in our horizon, which is in the next 3 years, it might become a universal bank. So that will be a big trigger. See, all these banks have been having a high operating cost since last 2-3 years. At some point of time, the operating leverage will kick in. And that cycle is ahead of us. So operating leverage cycle, as well as the fact that it will become a universal bank someday, and then the kind of growth that they are doing, and easily for a 25-30% kind of a growth for a decade from the size they are in is possible. So that is the kind of franchise you want to associate with. That is the kind of growth that we like. And I believe we are not overpaying for the banks at this point of time. So that falls perfectly in our framework of 3 to 5 year rolling view, 25-30% kind of growth and improvement in terms of margin and ROE.
Or are we from a real recovery in pharma where you would say that the excitement of 2021 is over and the pain of 2022 is something what markets have factored in?
So we had almost 16-17 months of consolidation period. So clearly, we dealt with the storm in a very mature way. It was more a time correction. We have digested all the bad news and we have digested the euphoria of 21 as well. See, there were some sectors which ended up, or some companies that ended up losing 50-60%. Otherwise, most of them managed to hold on to their gain with a 10-20% kind of a loss. So I think that period of correction, consolidation is getting over. The period of wealth creation is coming back as RBI has already paused, and some of the other factors of profitability are also coming into favor. So basically, see, India never had a balance sheet problem. India only had a P&L problem, and that was coming from the raw material inflation, freight cost increase, and some slowdown in growth. I think the raw material inflation has already eased, freight cost has already come down. The growth slowdown that came about has kind of been factored in most places, but there is probably export-facing sectors still have some amount of growth slowdown, maybe a couple of quarters. But besides that, I think at an aggregate level, India has recovered very well, and once growth comes back, in fact, the operating leverage will also come back, with leading to margin improvement. In fact, this quarter we are already witnessing some of the leaders in industrials, manufacturing, auto ancillaries, financials are seeing some margin expansion, which was not an expected phenomenon, I would say.
Ravi, hi, morning. We've sort of borrowed this line from you, the manufacturing renaissance, as you so well described it. And, you've talked about some top emerging themes in order to capitalize on this manufacturing growth. So can you just, walk us through what exactly those are?
So, I think confluence of factors. One, China wants to move away from manufacturing. Maybe it is because of pollution issues, maybe because they want to move their economy away from export-oriented to consumption-oriented. China wants to move away. Second is, world wants to move away from China in terms of their dependence, because of their over-dependence on supply chain terms on the China. And India has a huge populace that needs employment, and the kind of employment that manufacturing can generate cannot be generated by services sector. So we have no choice but to grow our manufacturing sector. Now, government is taking all the steps required to give the boost to the manufacturing sector. But it is not an easy journey. But we are already witnessing some early signs. So, for example, in electronics, I think we are in mobile, especially within electronics, we have become net exporters. I think that's a huge benefit for Indian economy. So we had a structural issue because we always used to run deficit versus most of our trading partner, and the number 2 item after crude was electronics that we were importing. And if we can start within electronics, mobile was the largest component. So now if we can start that manufacturing locally, I think we have a very good chance of correcting that structural flaw in the economy. So I think beneficiaries of that, the domestic electronics manufacturing outsourced vendor is one place that really excites us. I think there is a long runway. These companies can continue to grow at 30-35% kind of compounded for a long period of time. And so yes, valuations are not so cheap from current earnings perspective, but I think the absolute size of these companies are still very small, and over a 8-10 year period, they can really become larger. Something similar that happened in the chemical sector from 2014 to 2022, we had an 8-year fantastic run, and these companies went on to become really large. So, and they were getting more and more expensive along the way, but they stayed expensive for a long period of time until last year. So I think we are at the beginning of that outsourced electronics manufacturing in India.
Ravi, the simple India story is per capita grows, India grows. If India grows, per capita will grow. What is stopping you from buying some of these classics, like a pure play bet on any consumption or per capita name?
No, so it's not like we are not placing our bet. bets on consumption. We do like consumer discretionary. However, there are some near-term headwinds in the consumer discretionary, and the valuations are not so mouth-watering that you go ahead and buy. However, we are being picky and choosy and placing our incremental bets in the consumer discretionary space as well. But it is more probably will build up our position over the next 6 months rather than go all out at this point of time. So the same store sales growth for most companies is slowing down. Pricing environment is not very conducive. So what happened is post COVID there was a bunching up of the latent demand got bunched up, and now there is some kind of a fatigue setting in. So I would say once 2, 3, 4 quarters pass by, then a more sustainable consumption trend will emerge. And once we start moving up the ladder in terms of per capita consumption, we will again witness the kind of hockey curve growth that we are anticipating since a long time in various consumer categories. So, but this is going to be a category by category, not necessarily an across the board call.
All right, Ravi, really appreciate your time and so glad you could
Thank you
join
so
us.